Okay, so for this next video lecture, so we will be discussing about tracing and vouching, okay, as part of the audit procedure, okay, to be performed by the auditor. So when we say tracing, so normally this refers to selecting an account transaction, normally from a source document. Okay, so the auditor will use the source document and then he will follow it through the journal or ledger. Meaning, in tracing, the auditor here will use the source document and he will check if this source document, which is a proof, okay, that a particular business transaction occurred, is actually recorded in the journal. It was classified in the ledger, and the amount of that is included in the account balance, which is reflected in the financial statement. That is what we call tracing from the beginning of the transaction until it is reflected in the financial statement. This is the direction of testing, okay, in this case. Okay, so tracing will also test whether all transactions that occurred are recorded. Okay, so this is the main purpose of tracing, to determine the completeness assertion in the accounting records of the entity. So it has the primary objective of detecting also any understatement, meaning if there is a source document that was not recorded, so it will be a source of understatement in the financial statements of, or in the books of records of the entity. Okay, what about vouching? So vouching is here, this is just the opposite of tracing. Okay, when in tracing, the auditor will start from the source document to the records, whereas in vouching, the auditor will select or start from the accounting record, and he will examine the underlying source documents for that particular record. Okay, this is what we call vouching. So the opposite, just the opposite of tracing. Okay, so again, in vouching, the auditor will start testing from the books of the entity and then following through the source document. Okay, so here, vouching, or this is the direction of vouching. Okay, so in vouching, this provides evidence that items included in the accounting records have actually occurred. So in this case, it will satisfy the existence or validity assertions of the entity. Okay, if indeed those items which are recorded in their books really did exist. Okay, if there are supporting documents or source documents that also exist, and thus primarily detects overstatement. Okay, so that's why this is considered to be the opposite of tracing. Overstatement because in this case, there might be transactions which were recorded but were not actually, or did not actually occurred. Okay, so this is what vouching may uncover, okay, during the performance of this audit procedure by the auditor. Okay, so that is for vouching, tracing, and vouching. Okay, so in this video lecture, we will continue with the next topic about evaluation of misstatements identified during the audit. Okay, but somehow some of the concepts here were also discussed previously in our prior video lectures. Okay, so in PSA 450, this is entitled Evaluation of Misstatement during the Audit. Okay, so this provides guidance on the auditor's responsibility to evaluate the effect of any identified misstatements on the audit, and also of any uncorrected misstatements, if there is any on the entity's financial statements. So here, in evaluating the effect of misstatements accumulated during the audit, so the auditor here should distinguish between factual misstatement, judgmental misstatements, and projected misstatement. So how does these three types of misstatement differ from one another? For factual misstatement, um, these are misstatements about which there is no doubt, meaning there is really a misstatement that exists. Okay, this is factual misstatement. In contrast, judgmental misstatement, on the other hand, are those differences arising from the judgments of the management concerning accounting estimates that the auditor considers to be unreasonable. Meaning, this misstatement is due to the judgment or how the entity or the management interprets a particular financial framework and how they apply it in the preparation of their financial statements that resulted into a misstatement. Okay, that is what we call judgmental misstatement. Or it can also be the selection or application of accounting policies that the auditor considers inappropriate. Okay, and projected misstatement, on the other hand, are the auditor's best estimate of misstatements in a population. So this involves the projection of misstatements identified in the audit samples to the entire population from which the samples were taken. Meaning, here, projected misstatements, on the other hand, is on the part of the auditor because or since he performed sampling, okay, to gather audit evidence. Okay, so he estimated that this is the amount of or projected or estimated the level or amount of misstatements that may exist in a population. Okay, that is what we call projected misstatements. So those are the three different types of misstatements in which the auditor should consider. Okay, so the auditor should determine whether the overall audit strategy and audit plan needs to be revised. If the nature identified misstatement may not be an isolated occurrence, and the circumstances of their occurrence also indicates that other misstatements may exist. So when aggregated with other misstatements during the audit could be material. So this is the consideration of the auditor whether to revise his overall audit strategy as well as his audit plan. So if the aggregated of misstatements that is accumulated during the audit approaches material amount, so there may be a greater than acceptably low level of risk that possible undetected misstatement when taken with the aggregate of those misstatements which are accumulated could exceed materiality. Meaning, the auditor, as he goes or performs the audit procedures, okay, he accumulated misstatements which are considered to be immaterial. And when he aggregated those misstatements, it approaches to a material amount. So meaning, there is a possibility, greater possibility that there is high level of risk of material misstatement that may exist. Okay, so that's why he should, in this case, revise his audit strategy and audit plan. Okay, so the auditor should also communicate on a timely basis all the misstatements that was accumulated during the audit with the appropriate level of management, unless it is prohibited by law or any regulation. So it has to be reported. Okay, so the auditor should request also the management to correct those misstatements. So again, correcting of the misstatement is the responsibility of the management. So lastly, if the management will refuse to correct some or even all of the misstatements that is communicated by the auditor, then in this case, the auditor should obtain an understanding of the management's reason why they will not make those corrections. Okay, and the auditor will evaluate whether FS or the FS as a whole are free from material misstatement. So this reason should be acceptable based on the professional judgment and the guidance of the standards. Okay, that's how the auditor should determine if the reasons are acceptable or not. Okay, so those are how the auditor will evaluate the misstatement that is identified during the audit. Okay, so in this video lecture, we will continue with misstatements that is identified during the course of the audit, but it is still remained to be uncorrected by the management. Okay, so how should the auditor deal with this? Uncorrected misstatements, of course, these are misstatements that the auditor has accumulated during his audit and has not been corrected by the management. So the auditor in this case should determine whether these uncorrected misstatements are material individually or in aggregate. Okay? Also to determine if this has the effect also of misstating materially the financial statements of the entity. So in making this determination, the auditor will consider the following. First, the size and nature of the misstatements, both in relation to a particular class of transaction, account balance, or disclosures, and the FS as a whole, and the particular circumstances of their occurrence. Okay, so of course, materiality is very important in this case since we are talking about misstatement that was uncorrected. Another is the effect of uncorrected misstatements related to prior period on the relevant classes of transactions, account balance, or disclosure, and the FS as a whole. Meaning, if this misstatements relates to the prior period, does it have a material misstatement effect on the opening balances of the current period, uh, of the current period's FS? Okay, so that should be determined by or considered by the auditor. Okay, another is the auditor should also communicate with those charged with governance any uncorrected misstatements in the effect, okay, of these. It may be individual or in aggregate may have on his opinion. Okay, because in this case, if this uncorrected misstatements may prove to be material, then the auditor might modify his opinion. So that will have a great impact or effect on the management's assertion in their financial statements as well. Okay, so the auditor should also request that this uncorrected misstatement should be corrected by the management. And the auditor should also communicate with those charged with governance the effect of any uncorrected misstatements related to prior period on the relevant classes of transactions, account balances, or disclosures and the financial statements as a whole, because again, this might have the material misstatement effect on the opening balances of the current period's financial statements, and he may modify his opinion if that will not be corrected by the management. Okay, so those are the misstatements that were identified during the course of the audit, okay, which were remained to be uncorrected. Okay, so that's how the auditor should do, okay, in this case. And in this video lecture, we will also include the auditor's responsibilities in auditing accounting estimates. Okay, so what are his responsibilities for this? um, type of a particular transaction which relates to this. Okay, based on what the management has prepared in their financial statements. Okay, so an accounting estimate, this is normally a monetary amount for which measurement, in accordance with the requirements of the applicable financial reporting framework, is subject to estimation uncertainty. Meaning, accounting estimates is a subjective um, type, meaning depending on how the management uh, uh, interprets and relates to their operations, and whether they think this approach is what best fits, okay, to their transactions, okay, without probably considering its appropriateness. Okay, so this is subjective. Okay, because in this case, this is just as an estimate. Okay, so accounting estimates are often used when the precise amount cannot be determined, or when the outcome or the occurrence of future events is uncertain. That's why estimates are being used. Okay, so accounting estimates also may be required in computing bad debts, depreciation, warranty obligations, fair values, and impairment loss. So these are the examples of the accounts which are related to accounting estimate, um, or where accounting estimate is applied. Okay. So in auditing accounting estimates under PSA 540, so this is entitled Auditing Accounting Estimates and Related Disclosures. So this requires the auditor to obtain sufficient appropriate evidence as to whether the accounting estimate and its related disclosure are reasonable, okay, in the context of the applicable financial reporting framework. So he has to determine if that is appropriate. So the auditor should also obtain understanding of the procedures and methods in making the accounting estimates by, in this case, the auditor will do the review and test the process used by the management on how they develop the estimate. So in this case, the auditor will evaluate the data and the management assumption, and he will also do the testing of calculations, comparing prior periods estimate if that is consistent with the actual results, and he will also consider the management approval procedures if that is properly authorized. Also, the auditor should make independent estimates, okay, or he will reperform or recalculate if the entity did the correct measurement or application of such accounting estimate. And lastly, the auditor will review the subsequent events which confirm that the estimate made by the management. So this is how the auditor should do. These are his responsibilities in auditing for accounting estimates made by the entity.